There's a number of factors that go into an interest rate. Your credit score, how much down payment you're putting down, what your loan amount is, whether it's a condo, a co-op, a one family, a two family, a three family, a four family, what your debt to income ratio is, whether it's an investment property, a primary property, a second home. The other thing about interest rates is, as a loan officer, quote somebody an interest rate. That interest rate is quoted as of the moment that we quote it, right? It is not something that's set in stone. Mortgage interest rates change sometimes multiple times a day. Some lenders don't change interest rates perhaps for a week or a number of days, but they change based on market conditions. When there's sort of turmoil or uncertainty in the world or in the United States, interest rates will tend to come down, right? And if inflation is high and the economy's great and things are great, interest rates tend to be on the higher side, right? So for instance, if you think about when we had COVID, interest rates were super low. I was giving rates in the 2s and the 3s.
Yes, I remember
right?
that.
It was crazy. Why were rates so low? Because there was so much turmoil and uncertainty, right? Because COVID was upsetting to the world, what does the government do? Well, they lower the overnight lending rate, prime rate drops, interest rates drop, keeps people spending, right? You want to keep money flowing into the economy. So that's what happens. Now, if inflation's high and unemployment is low, then what happens is rates are high, right? Sort of pushes people back a little bit, right? So it's sort of like a balancing act. It really is a balancing act. The jobless claims number, and it was higher than what was expected. It was worse. It was worse than what was expected. What did that do? That actually brought rates came down a little bit, right? Because of uncertainty. So that's sort of how it works in the marketplace.